I published a new blog post last Thursday discussing my trades over the past few days. A link to my blog post can be found in the profile page here at YouTube. One topic that I will discuss near the end of this video are my purchases of municipal bonds maturing in about 20 years, rated AA or better, that have higher after-tax yields than the 20-year Treasury, and the improvement in the after-tax yield would be better if a investor has to pay state income tax on the Treasury interest, but not on a municipal bond interest for a entity located in their state. I discussed the 2025 third quarter GDP report in that post. The government calculated that real GDP increased at a 4.3% rate, much stronger than the consensus estimate made by economists. But 1.6% of that amount was attributable to the volatile international trade numbers, which are even more volatile now with the tariff wars. Exports from the United States increased 8.8%, the government estimates, in the third quarter, while imports declined by 4.7%. Government spending increased by 2.2% in the third quarter. Personal consumption expenditures increased 3.2%, while residential fixed investment declined by 5.1%. That category includes new home construction and major home improvements. Core real GDP increased in the third quarter at a 3% annualized rate, less than the 4.3% number, which includes consumer spending, business fixed investment, and home building, and excludes volatile categories like inventories, international trade, and government purchases. I would characterize the report as good, but not as good as many would conclude by just looking at the annualized 4.3% estimated growth in real GDP provided by the government. I hope this report will restrain another Fed rate cut, at least until the Fed has data that inflation is moving persistently back down to its 2% goal of annual PCE price inflation. More will be known about the inflation trend when the government reports the December consumer price index in early January. The report for November was simply unreliable due to data gaps and multiple assumptions and the absence of data that skewed the inflation number down. With annual real GDP growth above 2%, which is where we are in 2025, it may go as high as 2.5 or 2.6%, and annual PCE inflation near 3%, with some inflationary pressures building, there is simply no legitimate reason for the Federal Reserve to cut unless there is a persistent trend in inflation moving back down toward 2%, or a clear movement toward recessionary conditions in the economy. The real GDP growth numbers for the 2025 second quarter at 3.8%, up from a minus 0.5% in the first quarter. The current 4.3% estimate for the third quarter, and predictions of 2 to 3% in the fourth quarter are just not consistent with the persistently poor job numbers. Far more jobs would normally be created with those kind of growth rates. Part of the explanation may be the substantial spending on AI that creates few jobs or even results in job losses at many companies. This anomaly is discussed in recent articles published by Business Insider and Advisor Perspectives that I will link in the more section below. Consumer spending, I I would anticipate may decline significantly in the 2026 first quarter, particularly for those households that relied on incurring more debt to finance holiday gift giving, which would include the buy now, pay later type programs, and their finances were already strained significantly before those debt finance purchases. None of the foregoing analysis has much of any impact on my investment decisions now or for the past several weeks, or probably not for several more months. The focus remains on replacing some of the lower interest income, which I will receive in 2026 compared to 2025, from T-bill purchases at auction and dividend income paid by Treasury money market funds. And both of those are significant allocations for me. So I am buying primarily dividend paying stocks that have yields at my total cost or at my cost basis at least 4% or higher. Some may go up over 10%, particularly when I nibble in the business development corporation sector, BDCs. I discussed buying 5 municipal bonds in my last post. Those bonds mature in 2045 and have a 4% coupon. The purchase price was 96.448. The credit rating was at AA2 by Moody's and AA plus by S&P. The issuers, the Metropolitan Government of Nashville. The federally tax-free yield at my total cost was and will be, should say, 4.147%. The profit realized at maturity or early call will be $177.60. That profit is not taxable as a capital gain, but will be classified as ordinary income. I am buying some municipal bonds trading below par value that have 4% coupons or higher if I can find them, but I have to go out to the 1940s, usually somewhere around 1944, 1945 to find them. I would not be buying them if there was a possibility that I would have to sell them to pay expenses before they mature. That's a consideration. I am nibbling because the federal tax-free yield to me is higher than the T-bill yield and better than the after-tax yield of the 20-year Treasury bond, which closed last Friday at 4.77% using my federal income tax bracket. If an investor was at the 30% federal income tax bracket, the after-tax yield on the 20-year Treasury would be about 3.34% when held in a taxable account. I also view the diversity in my bond portfolio as important. As I've said in the past, I own probably over 300 different corporate bonds and a large number of municipal bonds that are stacked as to maturities, and the short end is mostly in Treasury bills and Treasury money market